We'll get going with the call today. If more people join, that's fine. Um, we're going to do it a little different today. We're going to start off with the market recap. I'll do a quick market recap. Then Hellman's going to go into some of the contracts we offer. We are going to be offering some different contracts that are over-the-counter contracts. He'll briefly touch on those. And then we got asked to do some terminology today. Going to start with spread terminology. I kind of gave this presentation to someone else. It's a little shorter than what I gave before, but I think it's kind of the basis of what we're going to, how we look at markets and what we're going to look at going into next year's harvest and what we look at when we merchandise grain. So we'll get rolling here. Market recap. I guess the biggest thing right now is we're kind of locked in ranges here. The market's looking for a reason to move one way or another. All that's led to is volatile moves. I think wheat's a perfect example. We're down 10 or 15 one day, up 10 or 15 the next day. And it's, a volatile trade that doesn't go anywhere. So the wheat market really has no new fundamental inputs. The crop's going into dormancy here. We're not really seeing any new export demand on the hard wheat side, even though price-wise we're getting more competitive with world values. We are starting to pick up at least what used to be routine destinations. We've seen cargoes to Nigeria. We've seen more hard wheat going to Mexico. But I don't think it's a balance sheet changer at this point. We'll be lucky to hit USDA's export number. So to really break out here, I guess we need to see a world crop problem, or we need to see USDA this week come in with low acres. Right now, USDA's we're expecting somewhere around unchanged up 2% on hard wheat acreage. So if they come in down on acreage, that could move the market short term. Otherwise, I guess the only other bullish impact we could see is the funds are incredibly short all wheat at this point. That includes Chicago, Minneapolis, and Mateath. If they decide to cover wheat, we could see a move and give us some good selling opportunities. That being said, the downside's probably pretty limited from here. I don't think we really need to move much lower on wheat. So I think if you still have unpriced old crop wheat, you stay patient, look for $5.75 to $6. And if we do get a move, you be aggressive and sell it. On new crop, I think we stay patient. There's a lot of time here, a lot of weather markets, a lot of uncertainty on world crops. So I think we have time to stay patient and look for 6 or 6.25 on new crop futures. Corn market, we were able to break out to the upside. We tried to rally above 450 and move towards 460. It just really struggles above that level. Every time we rally up into that area, we get a lot of farmers selling, and then we sell off a little bit and then grind back to that 450 number. We're going to need to see continued export demand. Right now, the U.S. is competitive with the world. The only other competitive origin is Argentina right now. So as long as we continue to see demand for U.S. corn, then, we should see a chance to sell 465 to 475. But I think the big thing to look at is people are anticipating bigger corn acres for this year and a carry out again above 2 billion bushels. And that means, this year we traded down to 375 for new crop corn. So I think if we get above 450 on new crop corn, you look to sell some here and at least lock in part of what you anticipate to grow. Feed market has been a wild ride. It continues to be a very volatile trade. but locked in a range just like wheat. So nothing really new out there. The cash market is weak. The crusher demand is slow as well, with crush margins not being as good as they have been recently. And the export demand is kind of dried up. The push from China has kind of disappeared, with South American beans being considerably cheaper. So there's no new big input there unless the Chinese decide they need to buy for the reserve and come in and buy overpriced U.S. beans. I think long term, looking at next year's beans, if South America doesn't have a weather issue, which right now they're talking about some dryness in Argentina, but the Brazilian crop looks to be big at this point. And I would say the upside in beans is probably the most limited out of the three we have up here. So look to sell any rallies if you have old crop beans left to merchandise. And then if you see a rally in new crop, I would do the same, sell into any rally and just take advantage of those opportunities unless we see some major changes. One thing we are getting into some new policies with the Trump administration coming on board, what they're going to do for tariffs, the last trade war was incredibly bearish commodities. So we'll need to see what his presidency brings for the grains, and how that's going to impact his policy will impact our export markets, mainly milo. That's the one that still has been waiting to see what the presidency will bring, and it still sounds like there is some hope for exports, but that might not be till March, April, or May at this point. So I'm going to close it off on the market recap side. Are there any questions before we move over to Hellman?
All right, thanks, Dave. Just want to kind of go over some grain contracts that we have to offer. As always, as I go through these, if there's any of these contracts that you would like for us to come out and put on any kind of localized training for your employees, reach out to me or RMA and we'll get something set up. So start off with just our traditional grain contracts. Everyone on this call should be pretty familiar with these. Your traditional hedge to arrive, your cash sale, and your basis only contracts. On these, I'm not going to dive into these real deep. The one on here that we've seen a big uptick in popularity, I would say, over the last 12 to 18 months is the basis only contract. Those producers that don't necessarily need that money at the time and are wanting to stop storage, this is a great opportunity for them to be able to set their basis, stop that storage, and then give it some time to be able to see if there's any kind of rally in the market. So we've seen a lot of producers take advantage of these. These are beneficial for CEA as well because it allows us to get ownership of that grain and be able to move it. The one thing on this to be able to talk through with the producer is make sure they understand how these basis only contracts work, that there is a set deadline for them to be able to set their futures price on that, and that if they're not going to set it by then, kind of how the roll process works, the difference in the spread between the 2 months that they'd be rolling between, plus the penny fee that CEA has to offer. So clicker. The next contracts I'm going to go over are options-based contracts. We've seen these really pick up in popularity since the Ukraine-Russia war broke out, and we saw the run-up on wheat. These minimum price contracts especially seem to be something that producers are looking at. What's great about these options-based contracts is that these give the producer an opportunity to collect on their money, get some revenue coming in, be able to pay some bills, while also keeping a little bit of skin in the game. If there's any kind of market rally, they'll be able to take part in that. So with all these contracts that utilize options, the premium cost is carried by CEA until the settlement of the check is cut. And the first one that I'll go through is the minimum price contract. That's a futures contract plus a call option, basically. And a minimum price combines a sold futures position with a bought call. Futures provides the minimum price for the contract, and the own call is how the potential upside is realized. If the market rallies, the call appreciates in value, and as long as it is executed and sold, the producer can add the gain into the price of the original futures position. Just like their futures or cash contracts, these option positions can have working offers in, and that's something we'd strongly encourage. So if like a producer spent 20 cents on a call and would be happy raising his net futures price by 30 cents, he could have a working offer and to sell that call for 50 cents and not have to think about it. And then the cost of this minimum price contract is just the cost of the premium for the call plus the 3-cent fee the CEA charges, which if they have a brokerage account that they're doing any kind of trading in with call options, that 3 cents basically just covers the in and out fee. Put cash contract is really just a different angle on a minimum price contract. It's a futures plus a put option. The upside future potential is open, but the minimum future price is secured by the put. As with the minimum price contract, the cost is the cost of the premium for the put plus the 3-cent fee. The last of the option-based contracts, the min-max contract, it's a put floor. The put is the floor and the call is the ceiling. You'll hear these referred to a lot of times as a window type contract. And the window is established through buying a put, which establishes the floor price, and then selling a call to establish a ceiling price. That window is established for the net cost of the premium. So whatever you buy the put for and then sell a call, the difference in that plus the 3-cent fee. When we look at these and we talk to producers about these, the minimum price contract gives you a little bit more, actually gives you, unlimited upside if the market rallies. But the min-max contract is sometimes more cost effective, but there is a ceiling on that. So if the market rallies like we saw in the Black Sea deal, there is going to be a limit to what they can do. The next type of contract is a contract the CEA has offered for quite a while, but we've really seen a popularity as we push this over the last couple of years, and that's the JSA Select contracts. This is a managed program by John Stewart and Associates. It's an actively managed type of contract, and it's a 1- and 2-year program they can sign up for. There's no hedge count needed and no margin calls on this. Their fee that they charge is a 6-cent fee, and it's deducted from settlement. As you can see there, the sign-up deadlines, we're currently in the sign-up for corn and soybeans right now, and then the deadline for wheat is November 1st. The corn and soybean prices are finalized by August 31st, and the wheat prices are finalized by May 31st. And then the futures are basically just determined by the net of the trading activity during those windows. The farmers determine the number of bushels that they commit to this program. And then they, like I said, they choose between a 1- or 2-year program. Most of them like the 2-year program just to give themselves a little bit more time to capture those market moves. The benefit to these is they don't really have to think about it. Once they commit these bushels to it, the JSA professionals price these contracts on behalf of the farmer. They also send out a weekly update email to the producer talking about what kind of activity they did on that contract throughout the week, or if they didn't do anything, why they didn't do anything. In my experience, producers really enjoy reading those emails. I've actually had some that have told me, hey, I hadn't done anything, on my wheat. And then I got that email from John Stewart and Associates, and they said they had done it, and this is the reason why. And it made me think about my marketing, and I went out and, did another 5,000 bushels on my own. So kind of keeps the producer's mind on marketing a little bit too, just through that weekly email. Contracts are made with and delivered to the local elevator, and then the farmers set basis prior to delivery, and 100% of the bushels will be priced. There's no double ups or knockouts. There's really not any kind of risk on these other than, just the 6-cent fee that they're going to pay at the beginning.